Most people find out how much house they can afford from their bank. That is the worst possible place to start. The bank will tell you the maximum they are willing to lend you, not the maximum that is smart for you to borrow. Those two numbers are very different, and confusing them is how people end up house poor, owning a home they technically qualified for but cannot comfortably live in. Today we are going to walk through the real formula, the one that actually protects you, the number banks use. Banks use something called the debt-to-income ratio, DTI for short. Your debt-to-income ratio is the percentage of your gross monthly income that goes toward debt payments. Gross monthly income means before taxes, before deductions, the number at the top. Most lenders will approve you up to a 43% debt-to-income ratio. Some will go as high as 50% with compensating factors like a large down payment or strong credit score. That means if you earn $6,000 a month before taxes, a bank may approve you for a mortgage payment as high as $2,500. That sounds reasonable until you see what is left. Why the bank number is dangerous. $6,000 gross is not $6,000 in your pocket. After federal taxes, state taxes, Social Security, and Medicare, you are probably taking home somewhere between $4,000 and $4,500 a month, depending on your state. Now subtract that $2,500 mortgage payment. You have between $1,500 and $2,000 left for every other expense in your life. Groceries, car payment, insurance, utilities, phone, childcare, student loans, emergency fund, retirement contributions, home maintenance. On paper, you qualified. In real life, you are surviving, not living. That is house poor. And it happens to millions of buyers every single year because they borrowed the maximum the bank offered instead of the maximum that made sense. The real formula. The formula that actually protects you is called the 28-36 rule. Here is how it works. Your housing costs should never exceed 28% of your gross monthly income. Your total debt payments, including housing, should never exceed 36% of your gross monthly income. Let us run it with real numbers. If you earn $6,000 a month before taxes, 28% is $1,680. That is your maximum comfortable mortgage payment, including taxes and insurance. Your total debt payments, including that mortgage, car payment, student loans, and credit cards, should stay under $2,160 per month. That is the line. Stay under it and you own a home comfortably. Cross it and the house starts owning you. What to include in your housing number. Most buyers only think about the mortgage payment, but your true housing cost includes several other expenses that hit every single month. Principal and interest. This is the actual mortgage payment that goes to your lender. Property taxes. These vary significantly by location and are typically collected monthly through your escrow account. Homeowners insurance. Required by your lender and collected monthly through escrow. PMI. If your down payment is less than 20%, your lender adds private mortgage insurance to your monthly payment until you reach 20% equity. HOA fees. If the property has a homeowners association, this fee is due every month regardless of your mortgage. Add all 5 of those numbers together. That is your real monthly housing cost. And that full number needs to stay under the 28% threshold. The quick formula you can use right now. Take your annual gross income and divide it by 3. That number is a rough ceiling for the total home price you can comfortably afford. $100,000 income, $300,000 home maximum, $150,000 income, $500,000 home maximum. It is not perfect, but it keeps you out of trouble while you run the full numbers. The one thing to remember, the bank is not on your side at this step. They are in the business of lending money. Lending you more is better for them. It is not better for you. The most important number in your home search is not the maximum the bank will give you. It is the maximum you can afford without changing how you live. Find that number first. Then go house hunting. Everything else comes after.